All right, everybody, welcome out today. So here is kind of our agenda today. We're going to be talking a little bit about inflation and interest rates. But before we start diving in too deep to anything there, let's go through some of the specifics. First off, there's my info, there's my bio required by license to make sure that everyone sees that. Here we are. So here's our agenda. We're going to talk about what's happened so far in April. Very interesting dynamics in the market. We're seeing quite a few, there's a lot of positive and there's some significant negatives that we're paying very close attention to. I'm sure many of you have seen the volatility that's going on in the markets right now. We're going to see if we can address what some of that is. We want to talk about inflation. So inflation is kind of the hot topic right now. There's been a lot of talk about like I-bonds and things like that, seeing some record returns that we haven't seen in many years, decades probably. We want to talk about interest rates, what the Fed is planning on doing to quell inflation, what we can do to, make some adjustments and make life a little bit more livable there. And then we will open up for some questions. I do have a takeaway section that I'd like to kind of address as well. So let's talk about what's going on now. April, as of close of market today, we still have a few hours left, but it looks like we're going to be negative. The S&P 500 and the NASDAQ and the Dow all trending in the negative for the month of April. So what we're seeing primarily is that we have a huge amount of volatility happening. We're starting to see those swings where markets are down and markets are up and markets are down in the same day by very violent, wild swings. That kind of volatility is never a good thing. It's never a good thing to see when the markets are trading at, the Dow is 500, 600 points down and ends the day 500 or 600 points up. Those volatility swings are bad for the market. So that is something that we're paying attention to, very close attention to, especially with the volatility that's going on kind of across the world. It's not like it's just domestics that are getting beat up. Internationals are getting beat up left and right and seeing those increased volatility. Now, here's what's interesting about this. Our job market, our labor market is the strongest that it's probably ever been in history. We've never had as strong of a labor market, as low of unemployment that we see now. Now, I understand that that's being manipulated to some extent. There are a lot of people that are moving themselves out of the workforce. But this is still a true point. You look at job markets compared to any point in history, there is more positive growth that way than anything else. We are also seeing for the first time since, it was about 2020 that we started to see the housing markets decline a little bit. We're starting to see those housing markets weaken. It's taking a little bit more time to sell properties. Properties aren't going for the crazy amounts over asking or anything like that. So these are kind of some indicators that we're paying attention to. Now, the number one indicator of technical data in the markets is earnings. So what's really interesting is I've got a chart here that'll show this in just a second, but 87% of companies that have reported their earnings per share, that's what EPS stands for. That just says like how much money they made over the last quarter. 87% of companies have beat their estimates. That doesn't happen very often. Usually that's indicative of a very strong market. But what's interesting about this is we'll see in just a second, even though 87% of companies have beat their earnings per share, the vast majority of those companies are trading 2 to 3% less the day after they report those earnings than they should. This kind of thing is a little bit scary. It means that we've got there's a lot of treacherous water ahead of us. Earnings per share is normally a good thing. If we're seeing positive earnings, that should normally be a good thing. We should be seeing positive growth of the markets, but we're not seeing it right now. Now, obviously, the Federal Reserve is playing into that. Mr. Jerome Powell, the Federal Reserve Board chair, and his other governors have been reporting about, they haven't really said what they're going to do, but they're making it sound like they're going to be a little bit more hawkish, which means they're going to be increasing the rates a little bit more aggressively than maybe they had suggested earlier this year. We've already seen one rate hike in quarter one. We went from pretty much 0.25 to 0.5. We'll look at what interest rates have done over the last little while, but they're planning on increasing those rates a couple of times. And that is a little bit dangerous to the markets. The markets don't respond very well historically to those increasing rates. Also very interesting, investor sentiment is like falling through the floor right now. Investor sentiment is what you and I believe about the market, like what the normal public feels about how the markets are performing and where they're going to be in the next 12 months. Very recently, in the last 2 days, the American Association of Individual Investors, one of the largest groups that studied for this, for the 4th time in history, have suggested that we are more bearish right now than we are bullish. So we're getting a lot of these very conflicting indicators. Earnings are fantastic, jobs are great, there's more cash on the sidelines than there has been in history. Americans are saving more cash in their bank accounts. M2 is larger than it's ever been. And yet we're still seeing indicators. Yield curves have inverted. If you haven't heard about that yet, we've got a great segment, an OWA live segment that's on our YouTube channel about that. So that's a kind of a scary indicator. And then all of us are kind of feeling a little bit skittish about the markets. And on top of that, the markets are in correctional territory. As of today, the S&P 500 is hitting that 15% mark. As of today, the NASDAQ is hitting down 22 or 23%. So there's quite a bit of volatility there. And then I don't know if you heard this, but our GDP was actually negative. Reported yesterday that we saw GDP loss or GDP decline over the first quarter of 2022. Very interesting there. The biggest argument that I've heard for that is that our exports were limited and our imports increased real dramatically. So there was this big spike that happened all at once, but never a good sign to see a negative GDP quarter, which could potentially mean recession. Here we are saying that nasty R word. So let's dive a little bit deeper. This is what I had mentioned before. So here's earnings per share. 87% of the companies that have reported are beating their earnings per share report. What's interesting about this is I read a news article this morning that said that they aren't beating it enough. They're beating the earnings per share estimates, but it's not by enough. We need more. So like Netflix, for example, posted a 10% increase, 10% over their earnings per share estimate. They reported that earlier this week. But all the investors were saying, well, we wanted 15%. We didn't want 10, we wanted 15. You get companies like Tesla who came out and said, hey, we beat our earnings per share by 81%. I mean, that's pretty huge. And then all of a sudden we get complacent and say, well, we want more too. We don't want just this down here. We want this way up here. So interesting about that, the full one-day close afterwards for those companies that are beating their earnings are down 2%. That doesn't make sense. That's not logical. And so this is usually a big indicator that something is brewing. We've got some volatility ahead of us. Looking at this is that AAII report, that American Association of Individual Investors. Only a few times in history have they suggested that we are showing more bearish trends. So through the early 90s with the Gulf War crisis and the recession that happened in the early 90s, there were 3 times that this AAII group suggested that we were more bearish. At the very, very bottom of 2008, the whole 2008 crisis, this is in March of 2009, they reported that we were in a bearish trend, but here we are now. This just came out yesterday, 2 days ago. So very, very interesting to see how everything is swaying a little bit more towards bearish patterns. I don't really know what that means. You know, you want to know what keeps me up at night? Seeing that we see this kind of volatility, even though we're seeing so much positive things in the market, might suggest that we are facing a market crash. We might be in the middle of a market crash right now. So I don't know. It's kind of an interesting discussion that we're starting to look at. Definitely something that we want to keep in mind. The biggest thing on most people's minds right now is inflation. So as we're facing some of the highest historic inflation that we've ever seen, I mean, this is rivaling like the 1980s with inflation. Here's an interesting chart that I pulled off of the Federal Reserve's economic data website. So this shows the change from the previous year with inflation. What does consumer price index look like a year rolling out? And so we can see through like the 70s and 80s, there was this period of pretty dramatic run up. But what was interesting about that, and what's so telling about where we stand today, is that this run up was somewhat gradual. The inflation increases were high, and we did see periods where inflation was sitting at 16, 18%. But it took 7 or 8 years for that to increase over time. It wasn't all at once. And what we're seeing now coming out of COVID and into kind of this new world that we're all facing, just an absolutely dramatic spike when it comes to inflation. Looking at that a little bit closer, this same chart just pulled in from 2012 to current. We're seeing this spike in inflation, and Americans are feeling this. I mean, this is what's hitting them directly. But I want to dispel some rumors here. A lot of people think that inflation is what's causing a lot of this market volatility right now. We don't see that trend. I don't think that's what's causing all this market volatility. Think about it this way. If Ford comes out and says, you know what, the price of F-150s because of inflation or whatever else, we're going to charge 20% more. That just means that on their earnings, they get to report 20% more earnings. So it's not necessarily a bad thing. Now we're seeing right now, even with beat earnings per share metrics, that's still not meaning very much. And that might be poking holes in this a little bit. But ultimately, as companies are able to charge more, they just pass those inflation costs on to the consumers, to you and me. So the stock market doesn't really care about inflation all that much. Historically, in times of high inflation, markets have actually done well. We've seen some good, strong growth because companies are just able to charge more, and we are the ones that shoulder that burden. But what's really interesting about this, how do interest rates affect the markets? That, I think, is a bigger telling concern as to what the markets are doing. As a matter of fact, the majority of the volatility that we saw at the beginning part of this year, most of that was because of fears of interest rates rising. And the Federal Reserve, that's all that they know to do. If inflation is high, the biggest tool in their tool belt is to increase interest rates, to slow the economy so that inflation quells a little bit. I'm going to go back a slide here. This inflation trend is not something that the markets or that the Federal Reserve likes to see. If they start to see this spike, this is something that's very, very concerning for them. And so they start to get real aggressive about the strategies that they implement to try and quell this as much as possible. So as we start looking at some specifics, here are what interest rates have been over history since like the mid 80s. Now I cut this point, and you can see where this line is like diving right there. With some of the regulations that were put in place, it helped to calm those interest rates down. Some of you probably remember that, the Reaganomics through the 80s. What's interesting about this is interest rates have pretty consistently fallen all the way since like 1978. The trend here is interest rates are going down. Now we bottomed out right after the Great Recession. So after the housing crisis, Ben Bernanke, the Federal Reserve Board chair, and Janet Yellen, the Federal Reserve Board chair after Ben, they kept the rates as low as they possibly could to try and stimulate economic growth. They were really concerned about recessionary trends. The markets were kind of a real touchy. The economy was really touchy. And then we started to see good economic growth. So this is about the time that Jay Powell took over. We started to see kind of this stair-step approach to increase interest rates. COVID kind of stopped all that. So as soon as COVID hit, the first thing the Federal Reserve decided to do, cut rates. We're going to go dovish. We're going to go as conservative as we can, drop the rates to the floor, and let's just hold and hope that we don't have another 2008-like crisis. Now, thankfully, because of that action, the economy came back booming. Because of this action by the Fed, we've seen just phenomenal growth. 11 million jobs are open right now. Huge amounts of cash are available right now. Economic stimulus everywhere. And that kind of saved it. You know, we could have seen 2020 become a real nasty economic recession, and it was very short-lived. We saw this little blip real quick, and then that was kind of the end of it. Well, here they've started to increase those rates again. And as they start to increase those rates more and more and more, that's going to cause the markets to be a little bit more and a little bit more treacherous. This, in culmination with the concerns that we might be in seeing GDP slowdowns, seeing where GDP is actually negative, and on top of that, seeing where the markets are. Mr. Powell over there in the Federal Reserve Board and all of his governors, they're facing some real difficult times ahead of them. If we are indeed facing a recession, the last thing that they want to do is be increasing the rates. As they start to increase those rates, it's going to slow the economy down. Man, that could put us on a standstill. That could be a very dangerous thing. So something that we definitely are paying close attention to. But again, the markets aren't responding quite like we would expect. Now, this next piece that I'm going to show you here, this is from Yahoo Finance. This is the day that the Federal Reserve decided to increase rates. So that was March 16th, 4 p.m. Eastern. They decided to announce, oh, I'm sorry, it must have been 2 p.m. Eastern because the markets close at 4. What's interesting about this is the moment they announced, the markets were doing good. We have this light blue line. This is the NASDAQ. This one here is the S&P 500. The purple line here is the Dow Jones, kind of the major 3 indices that we look at. They started the day real positive, even though they knew that the Federal Reserve was going to be saying something about interest rates that day. We saw a pretty significant decline right when it was announced. So this is a one-day look. But then after the Federal Reserve met and announced what was going to happen, the markets were like, well, maybe it's not so bad. You know, we were kind of expecting that something was going to happen. And we saw one of the strongest growth periods this year, right on the tail end of interest rates. As a matter of fact, looking at what the markets did the week after, here's where the Federal Reserve announced, and looking at the rest of the work week there, NASDAQ was up 8%, the S&P 500 was up 4.5%, and the Dow was up 2.5%. This is like directly conflicting with the information that I just gave you here. The markets are starting to get a little bit irrational. And anytime there's an irrational market, that's something that, you know, just pay attention. I'm not saying to sell out of the markets. That's the last thing that I'm saying. But when it comes to your strategy, you need to make sure that maybe some of the traditional metrics that we used to use, some of the surefire, this is what's going to happen, some of those are getting thrown out the window. So if we're planning on using those same kinds of strategies, they may not work in the next 12 to 18 months. So we've got to be cautious. I also like to look at, this is bond prices. So same kind of thing. This is when the Fed announced. Now we're looking at 2 things. So we're looking at the US aggregate bond. We're also looking at Treasury inflation protected securities, or TIPS. Those have been real popular here recently as kind of a hedge against inflation. The moment the Fed announces, we saw this cratering. And what I think is really interesting is TIPS cratered even more than the US aggregate bonds. Those normally wouldn't be as affected with this. But if we think through, if we think of second level investment planning, what's happening with these TIPS? Everyone's saying, well, inflation is probably not going to be as much a concern if the Fed can get these interest rates under control. If the Fed can announce a good policy for these interest rates, then that's probably going to quell inflationary concerns. And people aren't going to demand TIPS nearly as much if inflation isn't as much of a thing. So this cratering, but then all of a sudden these spikes that happen after this, we would expect as interest rates increase that these bond values continue to decline. And that at least has stayed consistent. So that's at least the one part of the market that we can say, yes, we pretty much have a good understanding of what's going on. As interest rates rise, bonds are going to fall. And thankfully, that has not been irrational. That has stuck pretty well true to form. The US aggregate bond portfolio is down about 5% on the year. That's probably going to continue to decline as interest rates increase. As interest rates go up, bond values go down, and we expect that. We think, I would say, as one of our takeaways here, we're expecting somewhere in the neighborhood of 3 to 5 more increases. I expect the Fed to come out and say, hey, we're knocking rates a little bit higher and higher and higher. Wouldn't surprise me if the next time that they meet, they increase rates by as much as 0.5% this time around. I don't think that that's going to be as detrimental to the market. I might be wrong in that. We don't have a crystal ball, but just given what's happened in this year with the crazy irrational exuberance, to take Alan Greenspan's term, I don't think it's going to be as crazy as all of us think that it is. And quite frankly, I think the markets have already baked into their returns these increasing interest rates. So one of the big takeaways here, I hate to give general advice to a whole bunch of strangers on the internet here, but I think bonds are going to get beat up. So we probably should avoid those bonds, or if we have bond strategies, we should make sure that we're tactical in how we're using them. I don't think you should just go buy AGG and hold on. I don't think you should buy a bond portfolio and just hang in there while interest rates increase. So we need to have an active strategy towards our bonds. If we're going to use them, they still are a good investment class. It's still something that we should look at. But how are we going to use them properly moving forward, especially as interest rates continue to climb? I would also, this is going to sound very financial advisory, but manage your risk. If you're concerned about what the markets are doing right now, if it's keeping you up at night, you're thinking, man, I really can't stomach this kind of volatility. That's not going to slow down anytime soon. The markets are not going to calm down, probably ever. So if we're in a position that's keeping you up at night, if it's, if it's making your stomach turn, you're thinking, man, I got to do something about this, then change it. Adjust your strategy. If you're saying, you know what, I've got pretty good risk tolerance, I'm not losing sleep about what's going on, fine, then don't change it. But manage your risk tolerance. You can't control everything. You definitely can't control the market, but you can definitely control how you are invested. We are still strongly recommending using active management. We think that active management is a very good approach towards these volatile markets. And some of our managers have actually done very, very well through all this volatility by looking actively at what positions they should be in, by buying and selling based off of asset categories. So that might be something to look at. Ultimately, just be aware of what you're in, know what you've got, and stick with it. If you've got something that you know why you have it, if I'm buying a certain stock or a bond or an annuity, then I should stick with it. If I have a good reason for that, then that should be my position that I use moving forward. So I know that, I don't have any crystal ball here. I don't know what the markets are going to do. And I can't tell you that Bitcoin's going to hit 100,000 or 10,000. But we should know what we're invested in. We should be managing our risk. And now is a perfect time to be doing that, especially with the volatility we've been seeing. Okay, so that's our discussion. We're 24 minutes in. We try to keep these discussions short. We appreciate you. If you have any questions or concerns about your own portfolio, whether it's managed with us or not, give us a call. We're happy to sit down and review some of these things together. If we want to dive deeper into, what happens as interest rates start to go up, or what can I do to better combat inflation, give us a call. We're more than happy to sit down and chat with all individuals about these different strategies. Thank you for joining us for our market update today. Hopefully this is helpful. Hopefully you're walking away a little bit better educated about what's happening with the markets right now. Again, feel free to check out our YouTube page. This will be posted on YouTube probably by Monday or Tuesday of next week. So feel free to use that resource there for more financial information. All right, everybody. Thank you very much. Have a good day.